Let's bring in David Zervos. He's Jefferies' chief market strategist and a CNBC contributor. David, it's great to have you here today because a lot of folks feel like this market is getting ahead of itself, to use that tried and true phrase. What do you think are the ingredients for it to continue to do well this year, to continue building on the gains that we've already seen? And why are we so strong right out of the gate?
Well, Kelly, Happy New Year, first of all. And let me just say, I think the two topics that you started the show with and that have been dominating all the shows this morning on CNBC are two of the big macro drivers that I think are propelling this market. One is housing reform, which I think is going to be a very big part of the administration's policy to tackle affordability. And a lot of that's going to center on interest rates, but also on the types of things we just saw with the single family home announcement. And energy. If this president, if our president can get house prices more affordable, get interest rates down, and get gas prices down, there's going to be a much different outcome, or much more likely to be a different outcome in November for the Republican Party than if those were to go in the other direction. Imagine gas at $3.50 to $4 or higher, and interest rates up 50 to 75 basis points at the long end, and mortgages following suit. That would not be a good storyline for come November. The opposite is what they're shooting for. And I think that's why there's so much focus on Venezuelan energy policy and so much focus on the housing policy. I think those are the two pillars that are really the keys to the election. And that's why we're seeing them in focus. Macro drivers. And I think the market likes it.
On the jobs report day, which we're going to get Friday, we got ADP this morning. How would you position for this? I mean, let's go to your bread and butter, and I can't wait to get it. I want to get into the red, white, and SPOOS trade, but let me just set it up in the following way. What does the market want? We all want the jobs market to recover, to continue. If it's too strong, I understand that might pose a little bit of a risk to what we're talking about here with rates and everything. So, what do you think what would be the best possible news on the labor market front right now?
Well, I think for the markets, a lot of strength is going to be a little bit disconcerting. So I don't think the market's going to love a blowout payrolls. And it would be an unlikely storyline because we have seen a pretty significant deceleration. And frankly, Kelly, this has been happening now for years. Since 2023, we've seen the unemployment rate rising. It's over a percentage point above its lows of the beginning of 2023. And I think the market and the policymakers are kind of not focusing enough on that. I heard Jim Bullard say this morning, 4.5 to 4.6, that's kind of neutral. Well, you know what? You have a maximum employment and price stability mandate. We were at 3.5 3 years ago. And I think it's, or at least 2 years ago. I think, actually 3 years ago. I think the story is, why can't we be at 3.5? We should be. We were there in 2019. And the Fed is playing, I think, fast and loose with the inflation story. I think the market's a little over-obsessed with the inflation story. And so I'm a little upset with where the debate is between inflation and unemployment. I don't think we can just leave millions of jobs on the table, and I don't think we should.
Yeah.
And I think we are, and a lot of it's coming from productivity gains and technology, and that's a great thing, but it's not great for those that are losing their jobs fast.